Since the 1960s, finance was really dominated by economic paradigms, where almost all of the material we taught to MBA students was basically derived from economic theories that we presented to them. But later on, evidence suggested that the theories really weren't supported by the data. So when we took them to the data, the evidence was very weak, to say the least. Right? At that point, we started thinking about alternative paradigms that could help explain the data better. Okay? Another problem with the traditional way of thinking about finance is that it says nothing about what individual investors should do. In other words, which stock should I buy? Which stocks should I avoid? The literature doesn't say anything much about that, because all it says is that prices should be set according to this model. Now, that isn't of much use to the individual investor who really wants to know, well, but that model doesn't help me decide which stocks to buy. I mean, it's not really very useful, because that model says that if everything is in equilibrium, in balance, then this is what should be. But what I'm interested in obtaining information on is that, well, what stocks are out of balance, because that's where the money is. But the theories have nothing to say about when things are likely to be out of balance, and how do I tell if something is out of balance? That's where behavioral finance comes in, because it tells us something about the mistakes that investors are likely to make, and how those mistakes are likely to translate into stock prices, and how I can look at the balance sheet of a company and its stock price and figure out if this stock is an attractive purchase. Have investors made mistakes in these stocks? Without really having a benchmark to figure out if investors have made mistakes, I can't really tell whether a mistake has been made in assessing the value of a stock. And behavioral finance gives me that benchmark.